Hi and welcome to the Market Alert for Thursday, the 16th of March 2023. So yesterday the market is being brutal. Futures crash as bank crisis slams Europe. Credit Suisse craters. Panic, meltdown, people crying. Swiss mess. Don't worry, bailout arrives. Credit Suisse to borrow 54 billion from the Swiss National Bank or Central Bank. Preemptively strengthen liquidity. So here we go again. Another one bailed out. So I think they're going to do them one at a time. Unlike 2008 where they had to print 800 billion in the US and 600 million in the UK to bail these banks out. They're doing it all as they come along by the looks of things. I love this rhetoric, don't you? The measures demonstrate decisive action to strengthen Credit Suisse as we continue our strategic transformation to deliver value to our clients and other stakeholders. It's vomit making, isn't it? Just like Powell with we have the tools, and then they create the tools. They don't have them, they create them as they go along because they haven't got a clue. SVB collapse, how financial crisis boosts the CBDC threat. Yeah, absolutely. And this subhead here as well. The UK's House of Lords described CBDCs as a solution in search of a problem. It looks like they just found their problem. Of course, this is what I've said all along about CBDCs, and I said to my wife this morning, they'll keep bailing the banks out because the infrastructure isn't in place yet to switch everybody over to CBDCs. So what they'll do is keep kicking the can. When eventually it's all in place, they will say that the old system is so systemic that you either lose your money or you transfer it into the central bank digital currency, and then they've got you by the balls. Everything you do, everything you spend, everywhere you go will be monitored by the government. And this is where this ends. So they're going to keep bailing out like they've done with SVB, Signature Bank and all the rest of it. They're going to keep doing that. That's why they're guaranteeing depositors' money. Stop the run on the banks. It's too soon. They knew this was coming when they started raising rates and the rules that they put in place in 2008. But unfortunately, it's caught them unawares slightly. The impact of raising rates from 0% to 4.75 is what's causing the problem inside of the banks with the long-dated bonds, which, of course, are dropping like a stone, causing an imbalance on the balance sheet. And, of course, they have 620 of unrealised losses, which we looked at yesterday. And speaking of clowns, this is a stunning headline. This is this Pillock Hunt. Yesterday, budget, UK economy will avoid recession, nice one, and inflation set there, says Chancellor, to actually plummet. I mean, incredible. It's going to plummet. Well, I'll tell you now, you're not going to see the cost of anything in the shops plummet in conjunction with this prediction, because that's all it is. I mean, utter nonsense. Absolute nonsense, and people buy this crap and soak it up as if it's real. I mean, there's just it just defies any sort of logical thinking. You know, the fact that the Swiss National Bank have just printed 50 billion, there's 60 odd billion in America. It comes back to the taxpayer in the end, and it'll be the same in the UK. They're bailing out the UK arm of SVB. It's underwritten by the UK government, i.e. the taxpayer. It's all inflationary. It devalues the currency. You have less buying power. And then this clot, masquerading as a chancellor, comes out and says that inflation's set to plummet. You really can't make it up. It is a clown show. The whole world at the moment is a circus run by clowns. Clown Schwab being the number one of the World Economic Forum. Anyway, rant over. Honestly, unbelievable. Unbelievable. Anyway, let's have a look at what we got for today's economic news and entertainment. 12:30 for the unemployment claims and Philly Fed manufacturing. And then 1:15 we've got a rate increase apparently coming from Europe of 0.5%. That's going to add a bit of fun to the markets. Then we've got the monetary policy statement. Let's see if Lagarde's got the balls to raise rates at 1:15. That's going to be interesting. And she's then going to be speaking at 1:45. So let's crack on and have a look at the markets yesterday, which you're fully aware of sold off, but let's have a look at it in a bit more detail. We'll kick off with the Dow. So once again, we see a new low for yesterday, taking out Monday's low when we saw the Dow move sharply lower. But again, you'll see the market coming off the lows, massive volumes yesterday, and trying to get back above the 5-bar moving average there overnight. Right, of course, the refinancing and support with the funny money for Credit Suisse has helped the markets. Yesterday, Credit Suisse lost 30% of its share value, which of course preempted the Swiss National Bank to come in and buy the market. And then once the deal was done, we can move back up. Nothing to see here. It's all over. Move along. So the high in the Dow for yesterday, or the day before yesterday, well, it's overnight for yesterday, if that makes sense, is there. And we've got to take out the 200 MA first in the 30-minute chart. But we've got the DP there. You never know what else is going to come out of the woodwork now. It used to be able to say, well, it should go back to the highs or do this. But I'm sure there are a myriad of other regional banks that have got problems that are going to come to light, which will need bailing out with taxpayers' money, irrespective of whether they say it's the Fed's money. It always comes back to the taxpayer. That's always been the case. So the Dow trying to make its way back in the weekly chart. We came down to just below 50% and is now finding a bit of support there as well. So back to the daily chart, you can see that we're starting to move back. So yesterday's high is going to be the first point indication of any strength coming into the market. Taking the previous day's high out is always an interesting one. See if the market can get back there. And that for the Dow is up at 32,200. Meanwhile, in the implied volatility, this spiking up again yesterday to 1981, up from the previous day, which I haven't got on there. It was down about 18 something. Let me just get a number. Let me just add the label on there. 1802. So the implied picking up a bit again yesterday, which you'd expect given the Credit Suisse losing 30% of its share value. So still a long way to go on the upside up to the 30 region, which we saw back in October, if we're going to see any sort of end to this. It's not going to end soon, and it's not going to end pretty either. Just going back to when we were talking about the CBDCs here, the other alternative, just 1 second. When we were talking about a crisis to boost CBDC threat, the only other alternative, if the banking situation does become systemic, is what Gerald Celente has always said, the trends forecaster of 40 years. When everything else fails, they take you to war. So always keep that one on the back burner. I think also in this article, doesn't it mention a rise in defence spending? Just keep that one in mind as well. Just join the dots, as they say. Anyway, sorry for the digression there, but it was just a thought that came to mind. Let me go back to the German DAX and carry on with looking at the markets. So in the German DAX, again, you can see this coming off the lows yesterday. The close is up here, the low down at the 78% retracement. We went through the 14,900 level, but we're back at above that and trying to get back above 15,000 as well. These are the upside targets should the market find any strength, but we're a long way off yesterday's high, which can be seen by the 30-minute chart as shown there. So that's 100, 200, 300 points to the upside to take out the previous day's high on the DAX. A break below the DP is likely to test the close and yesterday's low. Like I say, we're directionless at the moment. You have to trade based upon what you actually see, because it's very difficult to know what's coming out of the woodwork with these banks at the moment. In the 5-minute chart, you saw the sell-off yesterday all the way down. I managed to get quite a bit of this. I'll show you in a moment. But what caught me out was the fact that it actually shot down another 100 points before it had the climatic action. The momentum was already starting to move back to the upside, and then it went into 160 point range with 150 point ranges in between. And overnight, the market getting the news of Credit Suisse being bailed out, this adding a bit more momentum, as you can see there when the markets traded throughout Asia. and a bit of a, again, another 50, more or less 50 point trading range. DP crucial, market needs to hold above this at this time. So yesterday, £543, 15.22 in the profit factor, and 77 to 23 win-loss ratio. For the week thus far, 1631.95, profit factor of 589, and we've got 64 to 36 win-loss ratio there. So great week. I love this sort of volatility, particularly, as I just say, we've got these 50-point range swings, which are just great. So the sideways moves can be traded along with the bigger moves as well when you put everything else together. Okay, let's move on and have a look at the S&P and the FTSE. So in the S&P, coming well off the lows yesterday, 78% retracement back down to here, and back 50% from here to here. So yeah, the S&P making a bit of a decent recovery there. 30-minute chart, we see the sell-off in the European markets, and then very choppy, but eventually making its way up, and at the moment above the DP as well, so a lot more strength in the S&P than there is in the DAX and the Dow at the moment. That doesn't mean to say that it won't come down with the rest, but trying to hold and get back above that 4,000 level, which will take a moment or two because the high is only trading at 3929 there, but heading in the right direction. But like I say, we just have no idea what's coming down the line, do we? Markets, not S&P, FTSE 100, massive drop there yesterday. We'll have a look at that in points value in a moment. Through the 200 MA, trying to get back above this, but a real clear out in this market. Let's have a look at the weekly chart before we look at the 30-minute chart. Down 89% retracement from there to there, so a biggish sell-off. In the 30-minute chart, let's have a look how many points the FTSE dropped and what it thought of Hunt's budget. 327, massive move down for the FTSE 100 there. And it's about time, frankly, because it was way overvalued when you look at the weekly chart from October. Absolute insanity. So back 50%, just above the 62 there. So back 50% of its move, which is all froth in this area here. And in the currencies, we've got the GBP, JPY, that down strongly yesterday. An interesting thing with the dollar and the metals, which we'll look at in a moment. 30-minute chart, you can see the drop there, massive drop in this market for yesterday. And low to high was a total of 476 pips for this market. In the pound for yesterday, also down as the dollar rallied, down to 50% retracement, finding support overnight, as can be seen in the 30-minute chart. Now the Chancellor's done what he wants to do and say what he wants to say. So this trying to move back to the upside there. But it all depends on the dollar, which we'll look at now. So yesterday we see the dollar moving to the upside strongly there. Let's have a look at a 30-minute chart of the dollar index, which is very revealing given what was happening with Credit Suisse in the morning. There was a flight to quality, and I use the term quality with tongue-in-cheek and advisedly, because all currencies are devaluing because of the amount of money that is being printed. It just happens to be the better of the worst, as it were. So yeah, the dollar up yesterday, back down overnight, which brings us to the metals. Very interesting pattern yesterday. Hold this thought here, that the metals were up yesterday. Sorry, the dollar was up yesterday, and so were the metals, which you can see there. However, silver got absolutely slammed yesterday afternoon. It went to 22.50, if I recall, 22.44. There we go, there's the 22.50 line. So it went to 22.40 and then just got absolutely hammered all the way back down. Like I say, they don't want the silver to move higher. They'll do anything to keep this lower. Yesterday, the gold market in the UK made a new all-time high. Silver is 80% cheaper than it was in 2011 and 1979. Work it out. It's beyond me now, apart from I can have to say that it's just got to be manipulation. So gold up sharply yesterday as well. We're not back at the $2,000 for the US all-time high, but the UK high was achieved yesterday. And demand for the metals was high as well, as far as bullion, vault and co, seeing massive increase in demand. And I'm not surprised either that people are getting out of taking the cash out and putting in assets that are outside of the system, shall we say. So yeah, silver and gold up yesterday. Big move in gold. Overnight this holding quite well, so that leaves us just with the gold silver ratio to have a look at. And as you've probably guessed already, if silver's been hammered to the downside back to where it started, unlike gold which isn't back where it started yesterday, then we can only conclude one thing, and that is the gold silver ratio has to be moving back up. So let's have a look at that. So there you go. What a surprise. So the gold-silver ratio moving back to the upside there, started yesterday and is now going to retrace back, no doubt, to this sort of 92 level. Okay, I've gone on long enough, but a lot to cover, a lot going on. So I'll leave it there. And as ever, thanks for watching. See you in the next one.